The market has no memory. It does not care who you are, how hard you studied, or how confident you feel before pressing the buy button. Every day it resets. Every day it tests discipline. And every day, thousands of traders discover the same painful truth. Without structure, skill collapses under pressure. More than a century ago, Jesse Livermore understood this reality better than most. He made and lost fortunes multiple times. He experienced the intoxicating highs of success and the crushing lows of ruin. But through experience and costly mistakes, he distilled trading into principles, not complex formulas, not secret indicators, principles. These principles became what many now call Livermore's golden rules. Rule 1. The market is always right. Most traders fail because they argue with price. They believe their opinion should matter. They believe news, logic, or personal conviction overrides movement. But price is the final authority. Livermore understood that opinions are expensive. The market does not adjust to the trader. The trader must adjust to the market. When traders refuse to accept this, they hold losing positions longer than necessary. They average down. They justify, and they compound damage. Rule 2. Trade with the trend. Livermore did not attempt to predict every turn. He waited for confirmation. He waited for the market to show direction. Most traders attempt to buy bottoms and sell tops. It feels intelligent. It feels advanced. But it is often reckless. Trends exist because capital flows in one direction. Fighting that flow drains accounts. Aligning with it preserves energy and increases probability. Rule 3. Cut losses quickly. This rule is simple. It is also the most violated. Small losses are manageable. Large losses are destructive. Livermore knew that survival mattered more than pride. Traders who hesitate to exit losing trades are not protecting capital. They are protecting ego. The market punishes hesitation. Losses grow, confidence shrinks, discipline erodes. Rule 4. Let profits run. Most traders reverse the previous rule. They hold losers and close winners. Why? Because fear operates differently when in profit. A small gain feels fragile. Traders rush to secure it. Livermore understood asymmetry. One large winning trade can compensate for many small losses, but only if it is allowed to develop. Rule 5. Add to winners, never to losers. This is pyramiding, but done correctly. Increasing size only when the market confirms strength. Most traders increase size to recover losses. Livermore increased size when the market proved him right. There is a profound psychological difference. Adding to losers compounds emotional pressure. Adding to winners compounds confidence and controlled risk. Rule 6. Wait for the right opportunity. Livermore often described long periods of waiting. He did not trade daily for activity. He waited for conditions that matched his criteria. Modern traders struggle here. Constant access creates constant temptation, but activity does not equal profitability. Patience builds edge. Impatience destroys it. Rule 7. Avoid overtrading. Overtrading is emotional trading. It is revenge. It is boredom. It is addiction to action. Livermore understood that mental capital is finite. Every trade consumes attention and emotional energy. Most accounts fail not from one catastrophic mistake, but from many unnecessary trades. Rule 8. Control position size. Size amplifies emotion. Small positions allow clarity. Oversized positions distort perception. Traders see danger where none exists and opportunity where risk dominates. Livermore's great fortunes were built through calculated size, not reckless exposure. Rule 9. Study market behavior, not personal bias. Markets move in patterns of human psychology. Fear, greed, accumulation, distribution. Livermore studied behavior, not headlines. Most traders chase news. By the time news is obvious, the move is often complete. Understanding behavior requires observation. Observation requires patience. Rule 10. Protect capital above all. Capital is opportunity. Without it, skill becomes irrelevant. Livermore's greatest lesson came from losing fortunes. Protection is not pessimism. It is professionalism. Most traders fail because they ignore one or more of these rules. Some understand them intellectually but fail to execute them emotionally. Knowledge is common. Discipline is rare. The difference between amateurs and professionals is not intelligence, it is structure. Livermore's rules provide that structure. Without them, traders chase, overreact, oversize, and overtrade. With them, trading becomes controlled, deliberate, and sustainable. The market does not reward brilliance. It rewards consistency. And consistency is built on rules. Trading is not a battle against the market. It is a battle against the self. Jesse Livermore's story is often told through numbers. Fortunes made, fortunes lost. But the deeper story is psychological. His greatest discoveries were not technical. They were emotio. Now, he learned that markets amplify human weakness, fear of missing out, fear of loss, greed for more, hope for recovery. These forces operate invisibly. They influence decisions long before logic intervenes. Livermore understood that emotional control was not optional. It was survival. When traders enter the market, they believe analysis will determine outcomes, charts, indicators, patterns. But under pressure, emotion overrides analysis. A small loss becomes personal. A winning streak becomes overconfidence. A sudden reversal becomes panic. Livermore observed that the market's greatest moves occurred when the crowd was most emotional. At tops, euphoria dominates. At bottoms, despair controls decisions. The disciplined trader does the opposite of the crowd, not out of rebellion, but out of observation. Livermore waited. He watched accumulation. He studied volume. He respected confirmation. He avoided anticipation. Anticipation is emotional. Confirmation is rational. Most traders fail because they seek certainty. They want to know before acting. But markets do not provide certainty. They provide probability. Livermore accepted uncertainty. He operated within it. He controlled risk so that uncertainty did not destroy him. Another psychological trap he identified was the need to be right. Traders tie identity to outcomes. A losing trade feels like personal failure. Livermore detached ego from execution. He did not need every trade to succeed. He needed consistency over time. Detachment reduces stress. Stress impairs judgment. He also understood boredom. Markets spend more time consolidating than trending. Boredom tempts traders to create opportunity where none exists. Live. Livermore resisted this urge. He preserved mental capital during slow periods so he could act decisively during meaningful ones. Emotional stability compounds just like financial capital. The traders who survive are not the most aggressive, they are the most controlled. Livermore's life proved that even masters can fail when discipline weakens. His early successes led to overconfidence. Oversized positions magnified emotion. Losses followed. His recovery came not from better analysis, but from restored discipline. The lesson is timeless. Mastery is not permanent. Discipline must be renewed daily. Markets change, technology evolves, but human psychology remains constant. Fear and greed drive price as strongly today as they did a century ago. Livermore's greatest edge was understanding that he was trading people, not charts, and people behave predictably under pressure. Every year, millions enter the markets with ambition. Most will leave quietly. Not because they lacked intelligence, not because the market was unfair, but because they underestimated complexity. Jesse Livermore's life mirrors this cycle: ambition, success, excess, collapse, recovery. The first reason traders fail is unrealistic expectation. Fast profits attract participation, but speed increases risk. Livermore made fortunes quickly and lost them just as fast. The second reason is lack of risk management. Traders focus on entry precision while ignoring exit discipline. Livermore learned repeatedly that preservation is more important than prediction. The third reason is emotional inconsistency. Traders behave differently after wins and losses. Systems collapse under emotional variation. The fourth reason is overconfidence after success. Livermore's greatest losses followed periods of extreme profit. Confidence can silently evolve into recklessness. The fifth reason is failure to adapt. Markets evolve, strategies degrade. Livermore survived by observing change. The sixth reason is oversizing positions. Size magnifies psychological pressure. Many accounts collapse from excessive exposure rather than flawed analysis. The seventh reason is impatience. Traders want constant action. Livermore often waited weeks for ideal setups. The eighth reason is crowd influence. Social proof distorts independent judgment. Livermore profited by acting independently of mass emotion. The ninth reason is lack of journaling and reflection. Without review, mistakes repeat. The 10th reason is misunderstanding probability. Trading is not about being right often. It is about managing asymmetry. Livermore's life demonstrates that markets reward discipline, but punish excess. He succeeded when he followed structure. He failed when he abandoned it. The lesson is not about copying his trades. It is about understanding his principles. Most traders fail because they seek shortcuts. Livermore's story teaches that there are none. The market is not conquered, it is navigated, and navigation requires rules, discipline, patience, and humility. Those who survive long enough to internalize these lessons transform. Those who do not repeat the cycle. The market remains neutral. It rewards those who respect it. It humbles those who do not. And in that neutrality lies the ultimate lesson of Jesse Livermore. Trading is often described as a numbers game. Charts, percentages, probabilities, indicators. But beneath every candlestick and every tick lies something far more powerful than mathematics. Human emotion. Jesse Livermore understood this truth early in his career. Markets were not random machines. They were reflections of human behavior. Fear, greed, hope, desperation, euphoria, panic. These forces moved prices more reliably than any technical pattern. And if emotions moved markets, then mastering emotion was the true edge. Livermore's story is not simply one of massive profits and dramatic losses. It is the story of a man studying psychology, both the psychology of crowds and the psychology within himself. He began as a young trader in bucket shops, reading price changes off chalkboards. There were no complex indicators, no economic models, just price movement. He noticed something others ignored. Prices behaved in patterns because people behaved in patterns. When stocks rose rapidly, the crowd became optimistic. When they fell sharply, the crowd became fearful. Livermore realized that markets did not move because of news alone. They moved because of reaction to news. Reaction is emotion. Most traders enter the market believing that intelligence guarantees success. They assume that better analysis equals better results. But Livermore learned that analysis collapses under emotional pressure. A trader can design the perfect plan, but when real money fluctuates in real time, emotion interferes. Fear whispers to close trades too early. Greed whispers to hold too long. Hope whispers to avoid admitting loss. Pride whispers that the market must be wrong. Livermore recognized that these internal voices were more dangerous than any external market condition. One of his most important realizations was that being right is meaningless without emotional stability. A trader can predict direction accurately and still lose money if they panic during temporary pullbacks. Emotional control determines execution. Execution determines results. Livermore often emphasized patience, not passive waiting but strategic waiting. Markets spend most of their time in consolidation, noise, or indecision. Yet traders feel compelled to act constantly. Action feels productive. Stillness feels uncomfortable. But the market rewards those who wait for alignment. Livermore described sitting for weeks without placing significant trades. He observed. He studied price behavior. He waited for confirmation. He understood that forcing trades from boredom or impatience led to unnecessary losses. Impatience is emotional. Patience is structural. Another psychological trap he identified was the need for constant validation. Traders want to feel correct immediately. If a trade does not move in their favor quickly, doubt creeps in. They exit prematurely or reverse direction impulsively. Livermore learned to separate timing from outcome. Sometimes the idea was correct, but the entry was early. Instead of fighting the market, he would step aside and re-enter when confirmation strengthened. This required humility. Humility is rare in speculative environments. Success inflates confidence. Confidence, when unchecked, transforms into arrogance. Livermore experienced this cycle personally. After making enormous profits during major market moves, he felt invincible. He increased position size. He trusted intuition more than structure. He deviated from his own rules. The market responded with brutal efficiency. Losses mounted. Fortunes disappeared. The lesson was clear. Emotional discipline must be constant. It cannot be relaxed after success. Most traders believe losses teach discipline. In reality, success tests discipline more severely. Winning streaks create psychological inflation. Traders begin to believe they possess special insight. Risk increases subtly. Stops widen slightly. Size increases slightly. Small deviations accumulate. Livermore's later reflections emphasize that the greatest danger in trading is not ignorance. It is overconfidence. He also understood crowd psychology deeply. At market tops, optimism becomes extreme. Newspapers celebrate prosperity. Analysts predict endless growth. At market bottoms, despair dominates headlines. Fear paralyzes participation. Livermore observed these emotional extremes carefully. He did not trade based on personal feelings. He traded based on collective emotion reaching imbalance. When everyone believed prices would rise indefinitely, risk was highest. When everyone feared collapse, opportunity often emerged. But acting against the crowd required emotional independence. It is psychologically difficult to buy when others panic. It is difficult to sell when others celebrate. Humans seek safety in numbers. Livermore learned that profitability often requires standing apart from consensus. Emotional independence requires preparation. Without a structured framework, contrarian decisions become reckless rather than strategic. Another psychological insight Livermore developed involved loss acceptance. Most traders interpret losses as personal failure. They attempt to avoid them at all costs. They widen stops. They hold beyond in validation points. They rationalize poor decisions. Livermore viewed losses differently. He considered small losses as business expenses. They were tuition paid to the market. They were expected. They were necessary. This perspective reduced emotional resistance to exiting. Exiting quickly preserved capital. Preserved capital preserved confidence. Preserved confidence preserved clarity. Clarity allowed him to re-enter when opportunity improved. Many traders become emotionally damaged after a series of losses. They hesitate. They doubt their system. They overcompensate by increasing risk to recover quickly. Livermore warned against revenge trading long before the term existed. Revenge is emotional. Emotion is expensive. Instead of seeking immediate recovery, he stepped back. He reduced size. He recalibrated. Emotional recovery preceded financial recovery. One of the most profound psychological principles Livermore practiced was detachment from money itself. When traders focus on dollar amounts, fear intensifies. A $5,000 fluctuation feels dramatic, but when viewed as percentage risk within a structured plan, it becomes manageable. Detachment allows objectivity. Objectivity supports discipline. Discipline supports longevity. Livermore also understood that markets test identity. Traders often define themselves by recent performance. After profits, they feel intelligent. After losses, they feel incompetent. This identity fluctuation creates instability. He learned to separate self-worth from outcomes. A losing trade did not define him. A winning trade did not elevate him. Only adherence to rules mattered. The rules created stability in an unstable environment. Markets are UNC, attained by nature. Emotional certainty is impossible. The only controllable variable is behavior. Livermore's psychological framework revolved around controlling reaction rather than predicting outcome. When price confirmed his thesis, he added strategically. When price invalidated his thesis, he exited immediately. No debate, no hesitation. This decisiveness reduced emotional friction. Indecision creates anxiety. Anxiety impairs judgment. Clear rules eliminate negotiation with oneself. Another overlooked aspect of Livermore's psychology was resilience. He lost multiple fortunes throughout his life. Many traders would have permanently withdrawn after such devastation, yet he rebuilt. Rebuilding required emotional strength. It required confronting past mistakes without denial. It required adapting behavior rather than blaming external forces. Adaptability is psychological maturity. Markets evolve. Conditions change. Strategies must adjust. Emotional rigidity leads to collapse. Livermore thrived when flexible and disciplined simultaneously. Flexibility without discipline leads to chaos. Discipline without flexibility leads to stagnation. Balance creates sustainability. Ultimately, Livermore's greatest insight was simple but profound. The market is a mirror. It reflects the trader's weaknesses. It amplifies impatience. It exposes greed. It punishes arrogance. It tests fear. Success, therefore, begins internally. Most traders search for better indicators. Few search for better self-control. But the edge is not hidden in software. It is hidden in psychology. Livermore's life demonstrates that intelligence alone is insufficient. Strategy alone is insufficient. Capital alone is insufficient. Emotional discipline determines survival, and survival over time creates opportunity. Opportunity executed with discipline creates fortune. The market has not changed in a century. Technology has, speed has, access has, but fear and greed remain constant. And so the lessons of Jesse Livermore remain constant. Master the self, control the emotion, respect uncertainty, follow structure, accept loss, protect capital, wait patiently, act decisively. In the end, the greatest battle in trading is invisible. It is fought not on the chart, but within the mind.